Welcome back. It is 3 o'clock on the 9th of December. The week is just underway. We are looking at a little bit of a pullback today in the markets. We had some chill S&P in the morning, nice little directional move around just after 10 a.m. Eastern time to 11:05. Established a little range after that. We're down near the lows of the day for this final hour. So let's see if the low holds or if the low breaks. We haven't seen really any red days for a while. It has been a while, actually. So we had a red day. So last week was flat Tuesday, Wednesday, gap up Wednesday, and push and drift Wednesday. Wednesday to Thursday. Actually, Thursday finished slightly red. Friday gapped higher. We are, I believe, at 57 all-time highs for the S&P. I found a nice little tidbit this morning that I thought some of you might be interested in checking out. This shows the S&P 500 just closed at an all-time high. This says 50 times this year, so obviously this was within the last couple weeks. I believe as of Friday last week, that was the 57th. 57th. It's either 56th or 57th all-time high for the year. Now, I had one trader in one of my services this morning say, all these all-time highs, I'm getting really nervous about that. And so I wanted to find out, let's take a look and see, in some of our years, we've seen the S&P close out at 30, 40, 50 all-time highs. How many all-time highs have we actually seen? Is this like the only time we've closed at all-time highs at 57 times? And the answer is no, not even close, actually. So within the last 10 years of trading, we had 2013 was just shy of 50. 2014, we had over 50 all-time highs. 2017, we had around 60 all-time highs. 2021, we had 70 all-time highs. 1995, we were at like 75 all-time highs just for the year. So that's just cranking out. I mean, what's crazy is there's 251 trading days in a year. Okay. So put that in perspective. We've had let's use our numbers this year, and we're not done. Obviously, there's more to go. Is the market capable of another, maybe 3 to 5 all-time highs by the end of the year? Yeah, maybe. Okay, but we have 251 trading days. We've had 57 all-time highs. That's showing us that about 22% of our trading days are sitting at all-time highs, making all-time highs. That's pretty impressive. I mean, imagine this 1995 year where we had over 70. That's insane. It looks like we had close to 75 all-time highs out of 251 trading days. That's almost 30% of your trading days are sitting at all-time highs. So I just thought this was an interesting little news poll or data poll. This goes back to 1954. Just kind of put in perspective, like just because we're at 57 all-time highs this year does not mean we can't go higher. Doesn't mean we can't go to 59, 60, 61, 65. I mean, I don't know what the market wants to do. I spent a lot of time this morning talking about a potential pullback, and we'll see what it looks like. I mean, the last few weeks of trading, we can go back a ways here, but this is our election week. Okay, there's a week after election. There is our support right around that election gap. Market created a nice little base there, and then has been pushing higher ever since. So I just take a look at the broader market. It would make sense to me that we could see some pullbacks, some dips and pullbacks, and they're right in here. So if we pull back, where to? Well, we can pull back to the 21 moving average. We can pull back to the 50 moving average, and none of that does any major damage, right? This post-election pullback, the election gap, the pre-election pullback. I mean, to me, if I was going to turn into like oh boy, I think he might be looking at a top or maybe something a little bit more bearish. I mean, I think we have to take out the election lows, the pre-election lows, like back here. That would be where I would say I'm a little bit more cautious going into, the next, let's say 3 to 4 months. So, I mean, that would be a pretty big pullback if you ask me. Right? Like that's a big pullback zone. So if we went, let's say from the recent all-time highs, pulled back to that pre-election low, that's a 6.7% correction in the SPY. Okay. So your S&P, futures, whatever, I mean, 6 to 7% is a correction. Are we going to get there? I don't know. what news do we have unfolding over the next couple of weeks? We have a lot. We have 6 central bank rate decisions. A lot of this has been talked about at length. But between this week, next week, we have 6 central bank rate decisions, and most of these central banks are planning on cutting. The RBA, which is coming up the soonest this week, they're expected to pause at 4.35. The Bank of Japan is expected to stay and maintain their 0.25%. Every other central bank, Bank of Canada, European Central Bank, Swiss National Bank, and the Fed, all expected to cut over this week and next week. So there's going to be a lot of central bank activity, probably a lot of volatility coming in the Forex market. Then we also have the Fed next week on Wednesday, which is expected to cut. Will the Bank of Japan do anything to kind of piggyback off of some message? Are they going to play some tricks with the markets these last few weeks of trading for the end of the year? On top of that, this week we have U.S. inflation data, which is expected to print a higher CPI reading. So this week's CPI expected to be Wednesday morning, month over month, 0.3%, core 0.3%, year over year, 2.7. Okay, that is a long ways away from the 2.4 that we saw back in October, which was September's bottom, right? Right around that September rate decision, we essentially talked about this as inflation could be bottoming. And here is your US inflation index. And what I'm not loving about this is that September bottom that I talked about. This was at 1.01%. And right now we're looking at a reading of 2.85%. Now, I keep saying this. I know there's a lot of stuff that goes on into this. Okay. I'm wondering here, TRUUS. Let me see if that's actually a ticker here. Nope. Nope. That's some crypto nonsense. All right. I don't know if that was just an acronym. Anyway, this low to current inflation reading, it's a scary increase. This is up 1.84%. I just want you to wrap your head around that for a second, because we have seen a year over year 2.4% CPI. Imagine if that is up, let's say that increases, okay, to 4.24. Do you think this market would be sitting at all-time highs if we went from 2.4 inflation all the way up to 4.24 with a CPI year-over-year reading? There's no way, And so I just don't know if this market data is being suppressed because we only see it once a month, or if because there's all the factors and all the sectors and all the ways that the Fed can separate the data where it's like, oh, this is core inflation. This is excluding food and energy, which food and energy prices are going higher, right? Or we have housing inflation, which house prices continue to stay high, and 30-year mortgage rates continue to stay high. The 30-year mortgage hasn't budged. If we look at the 30-year mortgage, I can go to Mortgage News Daily. Has anything come down recently? Let's go to the 10-year note. Okay, if the 10-year note has come down, we're up 0.96% today. So we came down to 4.13. We're back up to 4.19. That's let's see here, almost a 1% spike up. Now it's not, oh my gosh, it's creeping up to 4.5 again, or it's back down to 3.7. It's not there. It's right in the middle. But if you take a look at your 30-year mortgage, as high as 7.5. Let's go back a little bit farther here. Okay, the highest we were was just over 8%. That would have been in October of last year. Okay, we came all the way down right before that September rate decision from the Fed. We were down into the low 6s. I mean, that's a pretty good improvement to be saving 2%. The problem is the bond market decided to do the opposite. The yield started to rip higher despite the Fed cutting rates. And we're looking at, we got Freddie Mac and Mortgage News Daily around the same. So if I zoom in, they're right around the same, 6.68%. So let's just say 6.69, 6.68, 6.7 for simplicity. Okay. So it's not a good thing. I mean, it's still peculiar, it's still peculiarly, I can't even say it. It's still really high interest rates, while house prices aren't really coming down that much. The average home price, let me see if I can find it here. Median home price. So we have median sales price of existing homes, median sales price of existing, oh my gosh, dude, existing single family homes. Let's take a look at both of these for a second. Okay, $407,000. And let me pull, I'm going to actually plug this in. This is HOMS. Let's add this in here. HOSME. So existing sales and DL existing home sales. I was looking for that single family, existing single family home sales. Let's add that too. All right. So 1.19 million. Well, is that inventory? Housing inventory. Oh, okay. I don't really want that. All right. I'll trash that one. But I do want to use the average price. Put that in here for some housing data. So median prices have come off the highs a little bit. So for existing homes, we're seeing some savings out there by about $19,000 to $20,000, but we are still seeing sticky high 30-year mortgages. Okay, so this is something that's not immediate, but the market's going to have to figure it out. Either home prices have to continue to come lower. Okay, with the 30-year rates obviously being sticky around 6.6, 6.7%. So either home prices have to come down to justify rates that high, or prices need to level off. And hopefully with the 100 basis points of cuts that we've seen from the Fed, hopefully the 10-year rate starts to reflect that. And if so, does this actually drop? So if we get into the low sixes by Q1 of next year, that would be encouraging. Coming into 2025, I'm wondering, just like anyone else, like how quickly do Republican policies and Trump as president, like how quickly do they act in 2025? Is it this immediate package to drill domestically and go after lowering energy prices? Is it a big tackle on inflation? Under the Biden administration, we released the CHIPS Act, but that wasn't deflationary. We basically just seen, inflation going up at a slower clip, but it's still inflationary. And we're right back to this conversation, which shows us that, look, inflation bottomed in September. China lifting animal spirits, adding money supply, global liquidity growing, stock market sitting at all-time highs. That is inflationary pressures to the upside, right? That's headwinds. This week's CPI data, does it come in hotter? 2.7, as expected, would be probably a good thing just to see the market not overreact. But if we printed 2.8 or 2.9, I could see the market reacting to that. If we printed 2.6, 2.5, I could see the market actually getting excited about that. So, I do think there's a lot riding on this week's data for rate decisions, plus the inflation data of the U.S., and then we have the Fed next week. Let's take a snapshot of something really quickly here. Let's go to the watch tool, because the probability remains around 85 to 86% that the Fed is cutting rates next Wednesday. Not this Wednesday, but next Wednesday. So let's take a screenshot of this, and I just want to have this as a reference point to say, okay, we're talking about this on, I'll make a note here, as of December 9, 24 at 3:16 p.m. Eastern Time. Okay? Because as this week's data unfolds, will this change? Right? Will this go up to a higher probability? Will this decrease and confuse the market going into next week's rate decision? Does anything change going out to the rest of the year? Not the rest of the year, but the rest of next year. So right now, going out to December, take a screenshot of this. So Fed Watch tool going out to December of next year, and mark the same thing. So as of, there we go. Okay, so just doing a quick comparison, as of right now, looking out to next week, and as of right now, looking out to December of 2025. If we cut next week, that is going to be at 4.25% on the low end of that window. And this would be the toss up between another 50 basis points of cuts in 2025. So this is if we cut next week. Then we're saying there's another 50 basis points in 2025, which would essentially be 2 cuts. Whether that is, March or May or the end of the year, I don't know. This would suggest, maybe 3 cuts. That'd be 75 basis points. So do we have 3 cuts at 25 basis points? Do we have one bigger cut at 50? I would imagine the Fed most likely is going to stay around 25 basis points and continue to be data dependent. We're going to have this, continued Fed. What were they going to do? What are they going to do every month? And it's like you can't see the market just move without having something tied to the Fed. And it does suck. It is really annoying to have the Fed be so instrumental and influential in the markets. But, for the last 20 plus years, what they say, what they do, 100% influences the market. You could even argue that it, 100% manipulates the market. So it is better to be on the side of those flows as opposed to trying to fade the Fed or fight the Fed. I think if you've been doing that for the last decade or two, you've probably been dead wrong. So it's not worth it. I know there's some skeptics out there that just say that, the Fed should be dismantled. Nobody should have this much power. It might be true. I mean, it'd be nice to feel that we wouldn't have to be at the mercy of an every month FOMC meeting or every 1 to 2 months FOMC rate decision. And so much is on the line every time that Jerome Powell speaks. And I'm pretty sure that he is going to continue to be chair through, I want to say, most of 2025. I think his term would end in 2026. See if I can find that right here. When is Jerome? Yep, there we go. When's his term up? Investopedia, let's see, 4-year term. Okay, so it'd be May of 2026. So new term was May of 2022. He'd have a 4-year go. So that'd be May of 2026. All right. So if the guy doesn't plan on going anywhere, we will see how the markets behave. Okay. All right. So where are we intraday? We are sitting here near the lows. Let's take a look from top down. Sitting, near the lows on the day. Percentage wise, 0.58 to the downside on the S&P. We're at 0.9% on the Qs. We had a pretty violent rip right to the downside, from high to low today. High to low, we had about a 0.97% move. We're sitting near those lows again, 0.9% off of that. Again, it'll be interesting over the next 40 minutes. Are we, chopping around here for a little bit of a range and then pressure kind of mounts for the rest of the week? Is this the pullback day that the market's like, yeah, good enough, nice pullback by the dip, and we go to higher highs by the end of the week, maybe, right? Or if something disappoints with inflation, do we actually give back some gains? Do we come back and have a big gap fill here? I don't know. We're going to find out. Okay. So 0.9% down on the NASDAQ. The Dow is down 1/3 of 1%, 0.33%. Russell also down. The S&P or the S&P, the Russell 2000. I've got the IWI, which is my growth, my top 200 growth, my IWM, which is my Russell 2000, and my IWX, which is my 200 value. So both are down. Okay, growth down 0.64, value down 0.56, IWM down 0.32. Take this back to SPX to see if we hold the lows or break the lows for the day. We're going to find out. Go back to this chart here. It's one pullback. It's one candle. This isn't the end of the market. It's like, we'll see. I think we can all see previous resistance becoming support, come back to the 21 moving average. Is that enough to bounce and have another shallow retracement? Do we pull back, 1%? I don't know, maybe. That pullback there would be 1.82%. If we pull back to the previous high, that's 1.48%. Okay. We'll see how healthy the bull market is. Are we still just playing those like 1 to 2% dips and then more all-time highs? Let's find out. Okay. Let's see here. Futures down. Let's go to the VIX. The VIX is up almost 10% today. This wasn't enough to get long the VIX. I'm still waiting to see if we settle into these lows in the low 12s, and I'll probably look at a long vol play. SVXY. I should have some good income running on SVXY. Let me check right here. SVXY. Check the portfolio. Right now, I'm up around $5,900 on SVXY. I don't have any shares. I bought that during the July August drop. I bought it around $40, let it go at 50. The rest is a bunch of puts. So a 54 put, 53 put, 35 put, and in profit on everything. So and part of that was because when I did add to those positions, the IV was so large that I just collected a lot of premium up front. So, I mean, this actually goes out to next Friday, which does actually make this kind of interesting. A part of me wants to like close these. My $55 put is around 60% profit potential. I mean, obviously to get 100% profit potential, I don't mind taking some ownership of SVXY. If I did, it's like owning. I mean, it's kind of like being short the VIX with some ownership, and I can obviously hedge my position. I'll probably just put on a collar trade, but I don't mind taking some shares. I'd have 100 shares at $55, or maybe 200 shares at 54.50 if I take ownership of both. But this is out to next Wednesday, or I'm sorry, next Friday. So we'll keep a close eye on that one. I don't mind allocating some to that, some capital to that. Okay, but protection to the downside will be important. If I'm taking assignment, I definitely want to protect any type of vol event. If we start to creep to all-time highs again, then this becomes a pretty easy repair trade. Okay, dollar index. I've mentioned this before. Anybody that's been following me in my live sessions, the last couple of weeks especially, I said watch for this bounce off the 200 moving average. It bounced off it last week for non-farm. It's holding that level right there. I just think that the dollar is not done yet. So I'm not looking to short the dollar without better confirmation. We don't have it yet. So if the dollar index is not below this 105.50 handle, I mentioned this morning, if we're greater than 105.50, I'd be scalping dollar long. If we're less than 105.50, I would be scalping dollar short. Okay. So right now, it looks like we're scalping long, coming back into previous levels. This is kind of the halfway point from this support to this resistance. Let's see what happens. Do we have the ability to get back to the same high again? Maybe. Okay. But to me, it's not short. I'm not shorting the dollar. Not yet. Okay. Oil, 68.13. Oil was up a little bit on the day. Go to the daily time frame. We are starting to fade a little bit of that move. You can see that that wick to the north. Notice on oil that we are still making lower highs. Lower high, lower high, lower high. And that is my big concern for breaking this floor. If we are making lower highs and equal lows, we either stay here to, either fake out and go higher, and we see inflationary pressure start to increase with energy prices going up, or we actually break the floor, and there's bigger consequences to the downside if we see a big break of the floor and then a quick run to, let's say, $60 or a quick run to $55. That might look good for inflation readings, but that's probably bad on the geopolitical spectrum for more potential Middle East concern and conflict. Not so much concern for the U.S. or Saudi Arabia wanting lower oil prices and more market share, but concern for oil-dependent nations that do not want to see lower oil prices. Okay, the other side of this is what about global demand? I mean, even though we've had a straight up, basically a war, going on war, Russia, Ukraine, now everything happening with Israel. I'm not even up to speed with like what ceasefires we have, what's going on. I mean, it's just a hotbed all the time, and despite that, like it wasn't enough to really spike oil prices. So that's why I think this floor is vulnerable. But let me see here. I want to see if I can get. I need a line graph of U.S. gas at the pump. I want a line graph for this. Let's see here. Visit web pages. Let's see here. Retail gasoline prices. Let me see if this shows it. There we go. So 3.17. I'm going to save this. I'm just going to go gas at the pump. Okay, I already have AAA gas prices saved. Okay, here's AAA fuel prices, but this one doesn't really show the line graph like I want to see. Right, gas prices, state averages. What I'm looking for is a line graph. Okay, not state to state. I'm just looking to see, are we going? So right now, this has been lower. Current average 301, week ago 304, month ago 309, year ago 316. So we are still trending lower. I just think this is important to watch. Okay, if we're looking at all grades, all formulations, retail gas prices, I'll make this really simple. If this goes lower, that is a good thing for inflation to stay at bay. That is also a potential catalyst to break the floor around $66 or $65 on oil prices right now. If this ends up going higher, let's say that we build a floor in here. Let's say this is a falling wedge. Let's say that gas prices start to trickle higher. Flip everything I just said. That's not good for inflation. Okay, that's good for there to be like a bear trap or some type of play off of that $67 support, and then oil starts to head back up into the mid 70s. Okay, so just something to spot check. If this is going lower, better for inflation. If this starts to put in some floors, starts to trickle higher, inflation data is going to come in, and I think Q1, Q2 next year we could have another kind of reality check. There's going to be a lot of stuff to digest in 2025. Okay, the debt ceiling gets revisited. You've got, inflation data just can't be hidden and stashed away like it's fine. Like nobody pays attention to it. It has been like hidden in the background. I mean, the markets did a pretty amazing thing where they just stopped paying attention to inflation, even though the Fed was talking about it all year. All of a sudden in July and August, the narrative flipped to be like, we need to focus on employment. That's more important than inflation right now. Well, I beg to differ. I think that they're both important. And we clearly have a more resilient labor market than what everyone thought in August and September of this year. But of all of a sudden, the narrative on inflation is like, hey, we took our eye off the prize here for a second. And if inflation starts to get higher and noticeably higher, I mean, you can't keep hiding that data. And the Fed can talk about we're sitting at all-time highs and jobs look good and we're just going to outpace and we're going to outgrow. But if wages don't outpace inflation, that is the breaker for the consumer. I mean, wages have been positive and have been positive for a while, and that's been the reason that these costs have been passed on to us and we're dumb enough to buy at higher prices. Okay? But if wages are getting lapped by inflation, it's going to be a reality check at some point. Okay? Does this make sense? All right. Zen in Idaho. Nice. Neighbor to the north. How's everything in Idaho? Okay. Any questions on that little rant on gas prices? I just think it's something to reference, something to watch. If this goes lower, watch that floor at $66, $67 on oil. Okay. If we start to put in a floor and start to go higher, that's where I think the reality check of inflation comes back into the news. Okay. Because look, right now, like I'm about to drive down to Park City area, like 45 minutes away from me. And right now I'm seeing gas prices at like 285 a gallon. Out here in the mountains, that's pretty good. Usually we've been, higher than the national averages by 15, 20 cents. Now we're slightly lower. National average is $3, $3.01. We're 285. So, I mean, as you pass those gas stations, you notice, oh man, it's down 10 cents. It's up 10 cents. You notice that stuff. So if I'm, noticing that we're back above 305, 310, 315, 320, then I want to come back and look at this chart. It might not matter immediately, but with this week's inflation data, I do think this is going to be something that the market's going to have to recognize at some point. Okay, I had a screenshot posted earlier today. Let me check here for interesting ideas. 401 accounts with balances at least $1 million. Wow, this is pretty interesting. So 401k accounts with a balance of at least $1 million jumped to a record 544,000 401k accounts over $1 million. That is up 56% from the 349,000 a previous year. Wow. Crazy. So 401k is doing pretty darn well. But when it comes to inflation, food prices are heading back up. Okay, PPI numbers are higher. PMI numbers are higher. China's still lifting animal spirits. US isn't doing anything different. The Fed's cutting rates as inflation is not going lower. So we definitely have some inflationary pressures that the market just kind of ignored for a couple months, and seems to be ignoring it now as we go into the end of the year. And they'll ignore it for a while until they don't. And as I keep saying here, until prices prove that they are going lower, or until prices prove that they're going to take out some previous levels or come back and find it, I mean, all I'm saying is any type of move into these levels of support, I would gladly add some positions 100, 144, 200 moving average. Gladly add positions there. Okay. If we hit the 21, I'm probably not going to go crazy and deploy a bunch of capital because that's just a little tiny pullback. But if we pull back to it and then go to all-time highs, sure, there's a nice little gain in the near term. But I'm more along the lines of, okay, this is where I want to add, right? I mean, if I did a move in the 100, 144, we didn't quite hit the 200. That's why I'm watching those levels, because that was a nice pullback. So I'm hoping we get another nice pullback. Now, most traders and investors don't want to see a pullback because that just makes it harder. Well, for me, I've got hedges, I've got protection, I can weather the storm, I've got capital to deploy, so I wouldn't mind having some type of pullback. It just means I can put more capital at use. That's all. If I don't, then I'll stay, 60% invested, 40% cash. And the cash is invested. I mean, I've got, some of the if you trade GOVT or BIL, that takes any unused cash and basically trades it at short-term treasury rates, which right now that short-term treasury rate, if you look at the US 3-month, 3-month is trading around 4.4%. So you're getting, on any uninvested cash, you're getting some pretty decent risk-free rates right now. But again, I'm watching that 10-year closely. Okay. All right, so that's a little bit of everything. That's the S&P, the NASDAQ, the Dow, the Russell, gold, silver, the dollar, oil. Talked a lot about gas prices, things coming up this week. Gold is still kind of an 8 to 9 day chop fest. Silver's had a bit of a better run today. I'm actually happy to see silver doing well. If you compare the two, here's gold versus silver. I wouldn't mind seeing this stock. This isn't stock. This is gold versus silver. If this heads lower, look, gold can just go sideways, but if silver goes up, then this instrument comparing the two goes down. I wouldn't mind seeing silver, gaining some additional strength over gold to hit a measured move. And so that measured move for me is 35.88 is my measured move on silver. If we could get there by the end of the year, I would be quite happy. My SLV positions, if we got to some fresh highs, SLV is right here, currently up around $35,000. Let's say, how many shares do I have total? 2, 5, 8, 1,000, 19, 2,200 shares. Okay, so if I get 2,200 shares, actually 2,200 shares, plus another $4. So if I have $4 of stock price movement at 2,200 shares, I get another $8,800 plus the 35K that I'm up right now. I'll be up 43.8. Does that mean that I want to take profit? Not necessarily. I'm trying to hold out for a run to 47. So if I go, let's say a move of $16 at 2,200 shares, that's 100% gain on my position right now. It's worth it to me. I mean, that's a 50% move, but I mean, the alpha that I can generate is this thing moves 50% and I'm making 100% on my current position. So I do like that, but I've got to hold for a little bit longer. The nice thing is we cleared these recent highs back in 2020. We have some simple technical measure moves to the upside. I'd like to see silver make our way up to hopefully some measured move around 48 to 50 bucks. Okay, Bitcoin 96. I said this morning. Either we keep drifting higher into the hundreds again. I would be mindful of this if we start drifting into the highs. Okay, if we have a pullback and then a way to get back to these highs, that type of divergence, I would be a little cautious of a top forming. Okay, so I'd almost rather see this. I'd almost rather see Bitcoin pull back a little bit. I said 90K earlier this morning into 80K, somewhere in that window. I'm looking to dollar cost average into a little bit more of the Bitcoin plays. So maybe adding in a credit spread on IBIT and FBTC, maybe looking at MicroStrategy and Coinbase if they're at attractive levels or the IV's increasing, maybe sell some more premium. But between 90K and 80K, I think that's an attractive level to see if we can get back to these highs again. But that's only about a 20 to 30% correction as well. So I still think traders need to be prepared. And this, look, technically speaking, this would be a really scary pattern for Bitcoin. if we came all the way back down into this election chop. That to me would be a scary pattern. Because if we come back here and we fall back, now we're going to start talking about measured moves and a 70 to 80% correction. Now, most longer term Bitcoin participants have experienced that, and that may not be a bad thing. But for everyone that's been buying and buying and buying and buying as it's going up, I don't think they're going to be happy with a 70 to 80% pullback. I don't know if that's going to happen. I don't know if that's going to happen. But I would say as long as we stay within, $80,000 would be a pretty strong support level. If we stay above 80K or this previous high around 75, that's really a nice, go zone for some really nice support. So 80K to 74, that's that previous high. If we just have some, little pullbacks or a sideways move, that could be a bull flag. So there's still upside potential. I'm still long. I think there's still some promise there with Bitcoin to go higher. Okay. All right. What else do we have here? Copper making a run with some China plays. China, I actually did a lot of work this morning. So I ended up taking about 80 management positions. Some are new trades, some are managements. I did a lot of rolling today. I posted this in my Discord. So I talked about this during my live session around 10:15 today. I closed out FXI for a winner. So I had 2 credit spreads, 10 contracts and 5 contracts respectively. I had bull put spreads. I closed out each one for about 75 to 80% return on, I'm trying to think return on capital. I closed out for like an 80% max profit. So to me, it was good enough. We had a nice little surge on China plays. There's limited upside for me on these trades outside of waiting longer. And just in case these China pops to the upside didn't hold and they started to fade again before the end of the year, I just decided to protect some profit. So FXI, 2 positions closed out. KWeb, I closed out a long call and closed out a bull call spread. That was actually a really nice return on capital. I got a 50% winner there. I rolled Baidu out and up, and that increased my profit per share to $8.76 if it gets called away. I rolled JD, which is it's an econ play. I rolled that out and up. I increased my profit per share to $2.93. So as far as income goes, I'll guess here. I'm looking at about $400 on FXI and around $600 on KWeb. This is per account, and another, let's go 876. That would be 876 plus around 1,500 times 9 accounts that hold this. So if all goes well, and the trades that I managed today and the per shares that I have right now with my covered calls, that is around $30,000 of profit on those plays. So Alibaba, Baidu, JD. I closed out KWeb already. I closed out FXI already. So I'm reducing the China exposure, and I'm holding as of right now Alibaba, Baidu, and JD. Those are the only 3 that I'm really exposed in. And there's some more upside potential. I'll see if that goes into and when I roll these out and up, I roll them out to like January 3rd. So these covered calls will be going into like the kind of the drift zone. I don't even know what the point of the year is. Like New Year's Day is Wednesday the 1st. The 3rd is on a Friday. There's going to be limited movement there. But if we just have like a melt up higher, I'd love to see it just not disrupted, limited trading hours, but let's get us some fresh highs into, New Year's week or into Christmas when we have, that's another thing too. If you think about the calendar right now, December 2024 calendar, let's just talk about how much trading we have left. If this is the 2024 calendar, think about this. There's not a lot of trading that remains. We have this week. This is a full week of trading, 16th through the 20th. Okay, I'm sorry, this is the 9th through the 13th. So we have this week, full week of trading. Okay, so we have full week of trading and a lot of news over this window. Full week of trading here with a lot of news. After that, if we come in post FOMC into the 23rd, this is why I said what is set in motion probably stays in motion. So I think that it is critical that getting through this 2-week window, we don't have a lot of technical damage done to the markets. Meaning, if we have a pullback this week, then we should have a recovery next week. If we have a pullback this week that recovers by the end of the week, we go into the FOMC with some higher highs. Because if we go into the 23rd, at a big discount, I don't know if there's enough volume or buying in that window from Christmas time to New Year's time, which would technically be your Santa rally. I don't know if there's enough buying power to necessarily move the markets back up to all-time highs during that 2-week stretch. This would be the 1st and the 2nd and the 3rd of January. Does that make sense? So there are 2 weeks to really see what this market's capable of doing and then set that momentum into orbit. It's already in orbit, but set that in motion where it just continues to maybe drift higher through the holidays to finish up the year, right? So I do think this is really, really important. If we don't finish this week or next week, at or near all-time highs, I think we're going to struggle to get to all-time highs by the end of the year. So, I mean, whatever kind of dips and pullbacks we have, I'm curious to see how the market responds with some aggressive buying just to kind of reposition for, pullback. Okay, maybe it's 1%, maybe it's 2%. If we have something a little bit, deeper, like a 2.5 to 5% pullback, that's going to sting a little bit in the near term, but there might be enough buying power and volatility and order flows coming in with CPI data this week and certainly the Fed, which all these things are just good excuses for the market to move. It's an excuse to open up the floodgates for volatility, open up the deployable cash, and we'll see where prices take us. But I just think this is one thing to consider. Okay, so let me take a screenshot of this. I'll reference this later in the week as well. Okay. All right. Big Mike, did you bring that up last week? Did you bring that up last week? Somebody's been bringing that up in my sessions. We had a conversation on that last week because yes, the blow off move from the DAX. I mean, it's not the farthest. It's not the farthest. There's no way that this is the farthest. Okay, we've moved around 9% higher. I go back on the DAX here. There's no way that we've only moved 9%. This right here going into 2015, this had to be a higher stretch away. So from this peak, I mean, you're talking 16% from that peak in 2015 to the 200 moving average. So it's not the furthest. So make sure we're not using definitive statements there. It's not the furthest. Now, is it in the higher percentile? Sure. I'll give you that. It's the higher percentile of it. Hasn't been that far away from the 200 in a long time, but it's not the furthest. So we've seen, 13, 14, 15% stretch away moves, but just like we saw back here in 2015, that 15% stretch away move actually formed a multi-month correction that got us all the way back down and then actually corrected harshly. And I'm not sure what year that was. When did this thing drop? I mean, that was 20. Wow. So same year. We stretched up into April 2015, and by August 2015, that is a nasty correction. That is a 25% correction in the DAX. Okay. All right. So, like I said, I'll give you the percentile move, but the combination, I mean, even bar count wise, we're not crazy far away from on the bar count either. Now we have stretched away, right? 9+%, which is notable, but even the bar count, we tested this thing back in August. So from this being a testing point and this being a testing point, I would say this: if we pull back and find some moving averages, there's still support there. If we just blow this top off, this isn't something you want to fade, but if we start to see price action suggesting that it's getting a little long in the tooth and it's hitting overbought conditions on all sorts of instruments, and we're stretching to those 15, 14, 15, 16% moves higher, yeah, sure, I'd like to get a little bit more bearish on the DAX, at least in the short term. Yeah. So I get it. I mean, and it's no different than the S&P. The S&P has a pretty heavy bar count, 278 plus bars or so. Percentage-wise, we've stretched into, I think, just shy of 10%. So from our high last week into, I mean, we're right at 10%. Okay. Does it mean it has to pull back and find it? No. But I would say that if we blow off this top a little bit higher, we get to 12, 13, 14, 15%. I'm more interested in heavier hedges, a little bit more of a heavy-handed downside, and probably like a 30 to 60 day hedge, just because I think technically speaking that's going to cause a At least a pause, at least a reversion, at least something that I could hedge and make some money on. Okay. Yeah. So look, a lot of this stuff is happening, right? I mean, India's been up, Japan's been up. Japan's been all over the place with the July to August swing, but the S&P is all-time highs. The Dow's at all-time highs. The Russell did hit all-time highs. The Nasdaq hit all-time highs. We're just off of these previous all-time highs, right? So all these things have moved. Doesn't mean we can't go higher. Doesn't mean that they have to be done, and that's as far as they go. I mean, that's definitely a fool's game to play. Like, I'm calling the top. This market can't go any higher. Look, man, for 90 years, these markets have gone higher. I mean, the S&P has been around since the 1920s. Um, I mean, at some point, does the SPY priced at 600? Does the SPY reach 1,000 and then we have a split and we start all over again? Maybe. If it hits 1,000, is that a 10,000 SPX? Maybe. Right? What about the Nasdaq? I mean, does the Nasdaq hit 25,000, 30,000? If you go out far enough in time, they'll probably find a way to get there. We just don't know what's going to happen over the next 1 to 3 months. 1 to 6 months could be ugly. But usually if you're looking out, and this is what the crazy stats are, if you have a horizon of like 5 years, you're like 80 to 85% probable of making money in a 5-year window just by staying the course and having a 5-year time horizon. If you look out 10 years, you start to get up into the high 80s or low 90s that you could literally buy the tippy top of the market, go out 10 years, and you're still 90+% likely to be making money, even with a terrible entry. And you go out 20 years, any time in the market since the 1920s, any time for a 20-year time horizon, you've always made money 100% of the time. So, and I get it. Like, not everyone falls in the 20-year horizon, and it's going to be like, well, what if I buy it today and I'm down, 20%? Well, yeah, it's going to suck, and I wouldn't go 100% invested right now. I would say allocate. I mean, just think about dollar cost averaging. If I allocated, 5% of my capital, another 5% of my capital, another 5% of my capital, so I can dollar cost average into it, we hopefully are scaling in at lower prices, even if things go higher, or scaling in at higher prices and get pullbacks and you get better discounts. But dollar cost averaging will kind of alleviate that all-in mentality, where that's where I think it's going to be the sting the most. For the traders that came out through the election, I mean, they've got all the potential risk. If all these traders or investors are sitting on the sidelines and they're like, this Biden administration and inflation, and I'd rather just be in bonds right now, and I'd just rather collect my 4% risk free. Well, and then they get more bullish here. They get more bullish right there at all-time highs. Okay, well, they need to be ready for, we could go higher, but they need to be ready for some type of correction, and it never feels good to be fully invested at an all-time high when the thing may be correcting. But if they've got cash to deploy, let's say it's a 25% allocation, right? And it goes higher. Well, you can do another chunk, another chunk, another chunk, but if it pulls back, you got to have some dry powder. That's all I'm saying. Right? I mean, any correction, it is nice to know that you can get in and you can deploy capital at better prices. Because if you're deploying capital at higher prices or the highest prices, you are on the hook for that full correlation of when this thing turns over, or if this turns over, you're going to feel it. Right? If Bitcoin turns over, if gold turns over, if the S&P, if the Qs, if everything turns over, it's going to be felt. And to what degree? I don't know. Be prepared for 10%. If 10% becomes worse, this is where I said a lot of traders would lose their mind right now. If we had a 10% correction and then we had a dead cat bounce and another 10% correction, traders would lose their mind. Right? Because everyone thought for a second here that the market was going to be crashing like crazy after that August deleveraging, but it didn't. And so now I look at that as, okay, well, this low to this low, I mean, these levels to me are really key. And that now gives the market a pretty decent amount of freedom to have some, I mean, I don't know if you call it elasticity or reflexivity or something, but this market could be melting up, and have something pull it back in a violent way, but have this discount be something that, investors are eager to buy. So anyway, I don't know the future, but if I've got cash to deploy and I do it down here, I'm a lot happier as an investor than I would be if I'm fully invested up here and I'm hoping and begging and praying that it goes higher. Because look, if it goes higher, it's so easy. I mean, the thing is we've had a 0.5, 0.6% correction today, a 0.9% correction. I mean, respectively, a half to 1% correction in the markets today, and I'm actually at a new all-time high in my portfolio, even with the markets pulling back. So I'm fine with that. Like I'll manage it, and hopefully, if I've got some downside here, I'll have some protection, and I'll have some hedges on MES and MNQ, and I've got some SPY plays and some Q plays. So we'll see. But all I'm trying to do is mitigate some of the downside, take some profit along the way if I can, if it pays out with a hedge, because usually my hedges are really good reward to risk. But if it goes up, it's easy, you know. And I told traders this morning on one of my services. I mean, we got into a couple trades on the S&P and the Nasdaq. And look, if we find a way to carve out a 50, let's say 58th all-time high, okay, or we carve out a 59th all-time high or a 60th all-time high, the trades we took this morning are going to be profitable. Right? And that particular service, that would give us 30. Right now, we have potential to go 35 for 35 with these trades. 35 for 35. This service has been running since early October. It's just letting the market do its thing. But if it pulls back, I might take a couple of losses, but I'm going to talk about, getting into the trenches and maybe repairing a couple of trades. But I don't know. We'll find out. All right, what else? Got a lot of links coming through here. Okay. Okay. All good, all good, all good. All good there. Oh boy. Car parade. Nice. Okay, any other questions for me today? 3:54, just a few minutes before the close. We did break the 11 o'clock lows just by a little bit. So let me do a quick spot check here. NVIDIA at 138. It's going to be an interesting week on NVIDIA. Let's go to AUR. Okay, I'm looking for this one to get up to $9 by next week. BAC. This one I am looking for price to get to 47. Ford 1060. I'm looking to see if we get up to $11. SoFi looking to see if we get up towards $17. And WBD looking to see if we get down to $10. So just a quick spot check on some short-term plays over this week and next week. And with the inflation data this week on Wednesday and Thursday, I will be looking for some SPY activity and some big order flows coming into those ETFs. So look, it's forecasted to print 2.7. Look, the market still found a way to carve out all-time highs despite the big jump in 0.2% higher. And the jump in, and this is the tricky part, right? It forecasted 2.6, came in 2.6. The market didn't really have an adverse reaction to that. It barely budged, right? So printing a forecasted 2.7, if it comes in 2.7, I don't know if the market looks at that as like, oh, it came in as expected. No surprises. But it's like, we're 0.3 higher, dude. We're 0.3 higher. Is nobody paying attention to that? So I just don't know if this matters to the market right now. This matters to me, but it doesn't matter to the market. And maybe it matters in 2025. Maybe the path of least resistance for the rest of this year through the Fed, through the end of the year, is higher highs in the market, not inflation. Okay. But if this keeps going higher, it is hard to think that the Fed is going to keep this inflation, below 3%. I think maybe that's the psychological trigger right now is like, as long as the market's not above 3%, then, or as long as inflation isn't above 3%, the market's not going to freak out. Maybe that's the case. But if we are over 3% on that yearly CPI, I mean, that's the headline that everybody sees right now. That's the headline that everyone knows right now. It never used to matter, right? The CPI stuff never used to matter until we had a huge jump in inflation. Now it matters. And now we can see how difficult it is for the Fed to be feeding this line of BS, which is, oh, we're going to be at 2%. We want a 2%. We want 2%. Then you wonder for a decade why the Japanese, the BOJ was talking about 2% inflation target. They have deflation, for crying out loud. So I think everyone in the U.S. right now would be begging for deflation. We're not getting it. Everything's more expensive. And I've said this before, but we're running at like a 4.2% yearly inflation since 2020. They can tell us 2%, they can tell us 3%, they can tell us 2.7. It's crap. It's 4+% inflation at the minimum since 2020. So it's out there, but market doesn't seem to care. And this is what's, look at this chart. If we're right back to where we started, this goes back to June, July of 2023. So we're no better off on inflation readings than we were a year ago. The difference would be that our assets are higher, right? 401ks are making all-time highs. Investments have made all-time highs. Bitcoin's been ripping to 100+% to the upside. So if you're invested, you can offset that inflation cost. If you're not, you're just watching stuff get more expensive and stay more expensive, and you're struggling, and it's paycheck to paycheck, and that's what sucks. Only like, I don't know, 30 to 40% of households are invested. So there's a lot of people out there that aren't participating in this crazy melt up and this crazy run that's been pretty straightforward the last 2 years. It's been a nice solid bull market. So the last couple years have been good. But if you're not participating, it sucks and it feels like you're getting left behind. Okay. All right. On that note, let's wrap it up here. We got our final minute. We're sitting near the lows, 0.63% to the downside on the S&P, 0.55 on the SPY with a little bit of lag there. Qs, maybe some literally last minute buying. The Qs have actually gone up. That's an interesting bounce. They were at 0.9+%. Now they're at 0.8. So we're seeing the Qs actually bounce a little bit more aggressively off those lows. I mean, that's not bad. That's $1 off those lows in the last 30 to 45 minutes. The Dow, any buying pressure here? Not really. The Russell, not really. So we're finishing at fresh lows on the Russell. The SPY is just off of those lows. The Q's actually had a pretty good rip in the last, the last like 20, 30 minutes. Look at that thing. So closing bell right there, and post-market, we're going to see it jump around a little bit. But Q's actually having some last-minute buying. SPY, some last-minute buying. Whether that gets faded tomorrow, we'll find out, but here's where we're at. Okay, S&P has started off on its heels with a little bit of a correction. Right? So we're red on the week thus far. We'll see what the rest of the week gives us. But a low from last week, a high from last week, and we're sitting right around the middle with inflation data on tap. And this is an interesting spot. Look at where we are right here to fill that gap. Okay. If that's all the market needed to find and fill, there's still a gap here. And yes, there's still an election gap, and there's all sorts of stuff. Okay. There's still gaps to fill. But if this is all the market needs right now to justify, okay, well, let's find our pullback. We found some balance, and then the market can justify, maybe a Tuesday, Wednesday directional day, and maybe we get right back to the same highs again by the end of the week. I don't know. If it gets more damaging than that, okay, we're sitting at this gap. If this market is lingering, or I guess searching or begging for more equilibrium, then we give some more of that back. We take out last week's low, and we look to see, does it pull back into inefficiencies, pull back into other gaps? I don't know. So I said this early in the morning. There's my low from last week, and there's my high from last week. Right here, I don't know. It's a 50-50 trade. So we'll see where the pressure mounts, and we'll see what the week unfolds. But just be prepared for some volatility. These 2 weeks, this week and next week, are the last 2 weeks of full trading for the year. After that, it's holiday disruption. Brokers have limited hours. There's going to be thin volume. There's going to be less liquidity. So over Christmas, over New Year's, I'm not doing a lot of trading. Okay, it's just going to be monitoring because the market's going to be closed for, a couple days of those weeks. All right. Sounds good. Have a good rest of the day. Thanks for being here. If you are watching live or you're watching this recording after the fact, I would appreciate the likes. Hit the thumbs up button. If you haven't subscribed to the channel, please do. If you'd like to follow me for free out there, here are some ways to do it. You can subscribe to the YouTube channel, of course, youtube.com/Chris Pulver. You can also jump into my Telegram channel, which I've got some followers right here. So I'll post this link. This is Chris Pulver Telegram. There's the link in the chat. If you'd like to join my Discord, also free. I just ask that you jump into my Discord and just use the public chats. Don't get lost in direct messages. I personally do not send friend requests and I don't send direct messages. So just know that you come into my server and you get a message, you think it's from me, it's not from me. So I ask traders to, kick that suspicious activity, help me ban and report those, scammer accounts that are always lingering in the background or lurking in the background trying to get people on DMs. It's so annoying. But anyway, I've got a Discord channel. I've got all my content in one place and all my links. So that's why I have a Discord channel. But here it is. So here's a 7-day Chris Pulver trading Discord. Right? So you can check those out, and no bots, no scammers. That's it. Okay. All right, buddy. Thanks for being here. Happy Monday. I'll see you tomorrow. All right. Take care. Bye.